Okay, let's unpack this week's whirlwind market news. From pivotal central bank decisions to, well, escalating geopolitical tensions, the global financial landscape is a maze right now. And frankly, it feels like we're navigating it in a bit of a fog. Here at the Deep Dive, our mission is clear. Cut through all that noise, give you clear, actionable insights into this complex global financial landscape, especially if you're tracking US and European markets. Think of this as your shortcut to really understanding what's moving the needle.
And that's exactly what we aim to do.
Yeah.
This week presents an intricate, almost dizzying web of central bank policies, simmering geopolitical situations, and crucial macroeconomic indicators. They're all converging right now to shape global markets. We've gone through the latest research articles, expert commentary, basically trying to extract those most important nuggets of knowledge, and some surprising facts too. Our goal is simple. Make sure you walk away feeling thoroughly informed, not overwhelmed, ready to connect the dots yourself.
Okay, so let's kick things off with the absolute epicenter of market attention this week, the Federal Reserve's upcoming rate decision. The air is thick with anticipation, especially after President Trump publicly stated his expectation for a, quote, big cut.
Indeed. And that public sentiment isn't isolated. It's broadly reflected in market expectations. The widespread anticipation is for a 25 basis point rate cut. That seems to be the consensus. What's fascinating here, though, is how some players, like Morgan Stanley, they're forecasting an even more aggressive path. They anticipate consecutive cuts. That could bring the terminal rate below 3%.
Wow, below 3%.
Wow.
So that raises a big question then. Why? Why the cut? Is it purely economic necessity, maybe concerns over a slowing labor market?
Right. Or is it political pressure? We're certainly seeing that. Or is it maybe just a strategic sort of preemptive move by the Fed to regain flexibility, perhaps before economic indicators force their hand even more aggressively? The why here is almost as important as the how much, I think.
And it's not just the if or how much, but who is making this incredibly consequential decision? What's the feeling like inside the Fed?
That's where it gets truly nuanced.
Yeah.
We're seeing the potential for significant internal dissent within the Federal Reserve. Some members might argue for no change at all, signaling, strong confidence in the current economy. Others could push for a larger 50 basis point cut, indicating maybe a more urgent concern about slowing growth.
So a real split possible.
Exactly. This could lead to a rare 3 or even 4-way split in the votes. And that isn't just internal drama, it signals deep uncertainty within the Fed itself, which makes their forward guidance even more critical than usual for your planning. It tells you they're genuinely grappling with the data.
Interesting. And you mentioned political subplots too.
Yeah, we're also seeing those play out. There's an ongoing lawsuit against Lisa Cook. Lawyers filed fresh arguments. There could even be a decision on her ability to stay as governor before the Fed meeting wraps up. Then there's Stephen Myron. His confirmation hearing is tonight. If he gets approved, he could potentially cast a vote tonight, adding another layer of complexity to an already high-stakes situation.
Okay. This internal debate, the potential for a split vote, that sounds significant. How should we interpret the Fed's infamous dot plot projections in this context?
Well, the dot plot is crucial for understanding the Fed's longer-term outlook, definitely. But there is a clear disconnect right now. Currently, markets are pricing in a remarkable 6 rate cuts by the end of 2026.
6 cuts. Wow.
Yeah. It's a much more aggressive stance than the Fed's own guidance is likely to suggest. So for us, the precise language, the magnitude of any cut, and crucially, the forward guidance from the Fed's statement, that will be paramount. It's not just about the immediate decision, it's about the hints they drop regarding future policy. This guidance will significantly influence investment strategies, especially around inflation expectations, the impact of tariffs, making it a key component of your economic compass, really.
Right. And here's where it gets really interesting, I think, because the Fed isn't operating in a vacuum, is it? Its decisions ripple globally, and other major central banks are making their own pivotal moves, creating this complex symphony of policy that you need to, conduct.
Absolutely, you've got it. Beyond the Fed, we're watching the Bank of Canada, the BOC. They're widely expected to deliver a rate cut, potentially positioning them ahead of the Fed in this easing cycle. If they move first, that's a signal. Then there's the Bank of England, the BOE. Their rate decision is coming up too. There's speculation about possible changes to their quantitative tightening program, their QT.
Selling off assets, right?
Exactly, reducing the balance sheet. And this could have significant implications for gilt sales, the UK bonds, especially given a larger than anticipated hole in public finances. That can create a lot of supply pressure in the UK bond market. We'll also be scrutinizing critical UK CPI, the inflation data, and labor market data due this week.
And what are the expectations there?
Well, despite market expectations for the BOE to hold rates until April next year, forecasts suggest UK inflation could surprisingly rise, maybe above 4% in the coming months. It feels like they're in a real bind over there.
Yeah, sounds tricky. And across the globe, what about the Bank of Japan? They often march to their own beat.
They do. The BOJ is not expected to shift policy this week. However, continued inaction while other global central banks ease. That could introduce significant volatility into Japanese government bond yields, JGBs, and potentially lead to a stronger yen. It's a classic divergence play. Also worth noting, Japanese markets were closed today, Monday.
Got it. And the ECB.
Looking back briefly, the European Central Bank met last week. They actually appeared more upbeat about the Eurozone economy. What's fascinating here is how these interconnected yet often divergent central bank actions create a very dynamic environment. For global currencies, regional equity markets demands our careful attention. The choices made in Washington or London or Tokyo, they don't just stay contained, do they?
No, definitely not. So given that global picture, it's fascinating to see how these forces are already showing up in specific market movements. What does this all mean when we zoom out? To the complex geopolitical factors influencing global markets. Let's talk trade, international relations, because the headlines are definitely heating up.
They are. The U.S. and China, they continue their ongoing talks in Madrid. A key focus seems to be the fate of TikTok, its looming U.S. deadline, a digital battleground, if you will. Beyond that, groundwork is apparently being laid for a potential meeting between President Trump and Xi Jinping in October, maybe at the AI Pact meeting in South Korea.
Okay, a potential summit.
Yeah.
But will it achieve anything?
Well, that's the challenge. Securing significant deliverables from these talks is tough. Why? Because China currently perceives itself to have the upper hand. That makes it difficult to nail down a truly productive summit. And this tension is also playing out in trade wars, technology disputes. China recently launched anti-dumping and anti-discrimination probes into the U.S. semiconductor sector, seen as direct retaliation after the U.S. added, 23 Chinese companies to its entity list?
Right, that economic tit for tat.
Exactly, and it impacts global supply chains directly.
And China's economy itself, it's showing some weakness, isn't it? How does that factor into this geopolitical chess match? What are the global reverberations?
Indeed. Yeah, the latest August economic data for China was, well, frankly disappointing. We saw missed targets for retail sales, slowing industrial production, fixed investment. It was described as the worst month yet this year for the world's second largest economy. Now, this weakness increases the likelihood of further stimulus measures from Beijing, which could be a double-edged sword for global markets.
How so?
Well, stimulus could boost sentiment, but it also raises questions about debt and sustainability. Interestingly, though, despite this negative data, Asian equity markets seem to be sort of shrugging it off, largely due, it seems, to the pervasive AI trade narrative.
The AI hype train.
Pretty much. This raises a crucial question for investors, for you. Is this resilience based on genuine technological innovation? Or is it a classic case of narrative trumping fundamentals? Because that could create a potential divergence you need to track closely, a sustained disconnect like that. Well, it rarely ends well.
That's a huge point. How sustainable is that AI narrative? If the underlying fundamentals of a major economy are maybe not crumbling, but certainly weakening, what are the biggest risks you see in that divergence?
The risk is a sharp repricing. If the AI narrative falters, or if China's stimulus just doesn't deliver the expected boost, it creates a brittle market where a positive story, however compelling, might be masking underlying fragility. Looking over to Europe quickly, Fitch Ratings recently downgraded France to A+ from AA, citing rising public debt, political polarization, the deficit projected around 5% with no clear horizon for debt.
Ouch. How did markets react?
Actually, quite muted. The reaction in French bonds suggests this downgrade was largely priced in. But while the market might have shrugged, it still points to fiscal challenges brewing in a core Eurozone economy. That's something to watch. And on a regional political note, the German far-right party, AfD, significantly tripled its support in recent municipal elections.
Right, another political shift to monitor.
Exactly. These geopolitical and regional economic developments, they generate both risks and opportunities across global markets, influencing everything from trade flows to investor confidence in specific regions, reminding us that economics and politics are really two sides of the same coin.
Definitely. Okay, now let's talk about the immediate impact of all these factors on the market. What are we seeing right now in key segments, like currency pairs, U.S. equity markets, commodities?
Okay, starting with currencies. The USDB pair. Currently pretty flat, it seems caught between the uncertainties of the Fed's potential dovish pivot and, well, France's recent credit downgrade. It's a bit of a tug-of-war. Wells Fargo, for instance, is recommending selling the US dollar against the euro. They anticipate a softer dollar.
Okay. And USDJPY.
The USDJPY pair sees the yen weakening, largely due to Japan being on holiday today, and the Bank of Japan's expected policy hold this week. It reinforces that divergence we mentioned earlier, the dollar index, the DXY, which measures the dollar against a basket of currencies. There's anticipation it could move towards 91.
And if that happens?
Well, if that happens, it would in turn make dollar-denominated assets like gold cheaper for non-dollar holders, which could potentially fuel gold's rally even further.
Interesting. And U.S. equities. We've seen some impressive runs lately despite the geopolitical headwinds. Some might call it an everything rally.
That's right. While futures are a bit mixed, maybe softer this morning, broader global stocks, including the S&P 500, NASDAQ, Dow, they're at or near record highs, indicating an ongoing everything rally. But as you noted, some might argue this everything rally smells a bit like irrational exuberance.
Yeah, potentially. What's your take?
Well, my counter-argument is that while there are always risks, the underlying strength in certain sectors, particularly technology, is undeniable. The AI sector remains a significant driver here. Mega-cap tech companies like Amazon, Meta, Alphabet, they're showing incredibly strong returns on investment. Look at Tesla shares, for example. Surged over 7% after Elon Musk bought $1 billion worth of company stock. That's a strong vote of confidence. Though Nvidia is now facing a new antitrust probe in China, reminding us that even the biggest players face scrutiny.
True. Any signs of rotation?
We are seeing an emerging theme, potentially. Investors may be rotating out of U.S. equities and into international, specifically European equities, perhaps looking for better value or just diversification as the U.S. market looks, well, a bit stretched to some.
Right. For those tracking market sentiment, the CNN Fear and Greed Index is a crucial tool. What's it telling us about the collective psyche right now?
Yeah, the Fear and Greed Index. It tries to gauge the market's prevailing emotion by combining several key components. Things like market momentum, volatility, the VIX index, investor appetite for riskier assets like junk bonds. Currently, the index is showing insert current reading if known, for example, extreme greed or neutral, which indicates insert specific sentiment, for example, a lot of optimism or a balanced view. This tells us that despite all the uncertainties we've discussed, there's still significant underlying optimism, or perhaps a fear of missing out, FOMO, driving investor behavior. It's a quick pulse check, really. Are investors feeling adventurous or cautious?
Got it. And in commodities, what's happening with gold and oil? Both seem tied to global risk sentiment.
Gold is currently near record highs, and the drivers are potent. We're seeing significant inflows into ETFs, the exchange-traded funds, and strong buying from central banks. Poland, for example, aiming for 30% of its assets in gold, China actively adding to its reserves. Morgan Stanley maintains a bullish outlook. They're forecasting gold prices potentially reaching $3,800, maybe even $5,000 by 2026, fueled by worries about a dovish Fed and ongoing de-dollarization risks. It's an important safe haven asset right now.
Okay, $5,000 gold, that's a bold call. What about oil?
Oil, specifically Brent crude, is kind of range-bound. Around $67 a barrel, this reflects a tension. On one side, geopolitical risks like Ukraine targeting Russian oil assets, Trump's threats of major sanctions. On the other side, concerns about global oversupply and slowing demand, particularly from China, which is a massive consumer. It's a battle between supply-side fears and demand-side realities.
Makes sense. And briefly back to European equities, any standout stories or surprising pockets of resilience there?
Absolutely. Despite that weak Chinese economic data we talked about, luxury stocks are showing surprising resilience. Performing well, actually. Attributed to underlying U.S. strength and the perception that maybe China's situation isn't worsening dramatically. Sort of a bad but not worse scenario, perhaps? Other notable stories. UBS considering a move to the U.S. due to new Swiss capital requirements. That's a big potential shift for a major bank. And Ørsted shares being impacted by a rights issue at a significant discount, which means they're issuing new shares at a lower price to raise capital. Signals some financial pressure there. These specific details and trends empower us and you to interpret market signals and identify potential investment narratives more effectively. Shows that beneath the broad market moves, there are always unique stories playing out.
Definitely. So as we look ahead, what's on the economic calendar for the rest of the week that you should absolutely keep an eye on?
Right, the week ahead. For a comprehensive overview, you can always refer to investing.com's economic calendar. It's an invaluable resource, really. But the key dates and data releases as of today, Monday, September 15th, 2025 are: on Tuesday, we get U.S. retail sales. That gives us a fresh pulse on consumer spending. Wednesday is, of course, the week's most anticipated event, the Federal Reserve rate decision, complete with their statement and those dot plot projections.
The main event.
The main event. Then Thursday brings the Bank of England rate decision with their own challenges around inflation and growth. And on Friday, we'll see the Bank of Japan rate decision, rounding out our central bank trio for the week. This roadmap provides a clear guide for staying informed and prepared for the data points that will drive market narratives and potentially significant volatility in the coming days.
What an intense week already. Wow. We've covered the interconnectedness of central bank actions, global politics, market sentiment, how they're all converging to create this truly dynamic and yet times perplexing financial landscape. It sounds like a truly dizzying array of factors pulling markets in every direction. As you look at all this, what's the one maybe overlooked piece of information that you think has the potential to really surprise us this week?
That's a great question. This deep dive reveals a striking tension. While global central banks grapple with this delicate balance of inflation and growth, the lines between economic policy, geopolitical strategy, even social media influence, they're becoming increasingly blurred. What's often overlooked, I think, is not a single data point, but the speed at which these narratives can shift and reprice assets. As investors, you're not just watching numbers, you're navigating a rapidly evolving global narrative where, a tweet can move markets almost as much as a jobs report sometimes. So, what will ultimately drive markets? Fundamental data, political will, or the collective sentiment shaped by these intertwining forces? That, I think, is the provocative question for your week ahead.
Great question to ponder as we move forward. Thank you for joining us on this deep dive. And we encourage you to continue your journey of informed discovery.